Welcome to my tutorial on cash budget. If you are coming across my lecture for the first time, please don't forget to click the red subscribe button and also turn on the notification bell icon so that you don't miss my upcoming videos. If you are a returning subscriber, I say thank you. What is cash budget? Cash budget shows the forecast. It shows the forecast cash receipts or cash inflows and cash payments. Cash inflows, cash outflows. Cash budget shows the forecast cash receipts and payments over the budgeted period. It shows the forecast cash inflows and cash outflows over the budgeted period. Cash receipts, inflows, cash payments, outflows. So both cash receipts and cash payments are brought together in the cash budget. The essence of cash budget is to ascertain the cash balance at the end of the period or the cash balance over the budgeted period. So cash budget shows the summary of the cash receipts and cash payments over the budgeted period. XYZ cash budget for the quarter ending March 31st, 2024. So you may have total. Let's say you have the month of March, February, January. So in cash budgets, we normally have receipts. The receipts may include cash received from customers. Cash or proceeds from sale of non-current assets. So let's assume the non-current asset was sold in the month of February. The amount realized from sales, the proceeds. So you may have it as an inflows. Capital receipts. Then rent receipts. All items of receipts, you have them in your cash budget. That is total receipts. They have that as A. After receipts, you have payments. Payments to suppliers, rent and rates, wages and salaries, payments for insurance, payment for transport expenses, all other payments. We have lots of items, any expenses paid, other payments. There are a lot of items of payment you may have depending on the questions. So you sum up the payments, you sum it up. So you have the total payments. They have that as B. You now subtract your total payments from the total receipts. You arrive at the net cash flows. Net cash flows. That is total receipts minus total payments. After net cash flows, you have opening cash balance. You add the opening cash balance to your net cash flows, then you arrive at the closing cash balance. Your closing cash balance will be your net cash flows plus your opening cash balance. The closing cash balance in January will be the opening balance in February. When you sum it up, you arrive at the closing balance as well. The closing balance in February will be the opening balance in the month of March. When you sum it up, you arrive at the closing balance. So the closing balance in total column. This is just the skeletal format of cash budgets. What are those items that should not form part of cash budgets? Remember, I've told you that cash budget shows the cash inflows and cash outflows, meaning that anything that does not involve flows of cash, they should not be recorded or entered in the cash budget. So anything that does not involve the flows of cash should not be recorded into the cash budget. In fact, cash budget, remember, you record transaction on cash basis. Maybe you have sales. If you have credit sales should not be recorded in the cash budget until there is a receipt. You only enter the amount received from customer into the cash budget, not the credit sales. The same thing happens to credit purchase. So credit purchase should not be recorded in the cash budget until payment is made to suppliers. So you record the amount paid to suppliers in the month or time that payments are made. You record them into the cash budget. So items that will not form part of cash budget. Items that will not form part of cash budget. We have accrual items. Accrual items or non-cash items such as depreciation. So depreciation, no, it doesn't involve flows of cash. Therefore, it should not be recorded in the cash budget. Amortization, impairment loss, profit from disposal of non-current assets. No, profit follows accrual principles. Don't confuse your profit from disposal of non-current assets with the proceed. Profit will be the excess of sales proceed over the carrying amount at the date of disposal. That will give you the profit. But the actual sale proceed will be recorded when cash is received. But profit will not be recorded. Then loss on disposal of non-current assets. Loss, the same thing applicable to profit. The same information, the same process. What happens to profit is also applicable to loss. So I want you to take note of that. All these accrual items should not be recorded into the cash budget. Number two, or let me say even the net book value of an asset, net book value of non-current assets should not be recorded into the cash budget. Take note of that. Number two, appropriation of profit. Appropriation of profit. By appropriation, we mean distribution. Distribution of profit, such as dividend proposed. Dividend proposed. Don't confuse your dividend proposed with dividend paid. Dividend paid involves the flows of cash. Therefore, Dividend paid will be recorded in the cash budget. But dividend proposed, this hasn't involved the flows of cash. Therefore, it should not form part of the cash budget. We don't record dividend proposed into the cash budget. Number 2, transfer to reserves. Transfers to reserves does not involve flows of cash. It's just an appropriation of profit. Items such as fair value gain or deficit. This item should not be recorded into the cash budget. Take note of that. Items that does not involve the flows of cash should not be recorded into the cash budget. Take note of this. So, these are the examples of items that will not be recorded in the cash budget. Example: the general manager of Housing Corporation of Rimi State has requested for the cash position of the organization for the first quarter of the year 2008. The following information is available. 1. The total annual subventions from the federal government in 2007 was 15 million naira. There is expectation that this figure will increase by 10% in the year 2008. The expected 10% increase will be received in the first 6 months of the year, along with the normal monthly allocations. Note 2. The management has decided to reduce transport and traveling by 5% in the year 2008. The total amount in year 2007 was 1,890,000 naira, and the expense will accrue evenly throughout the year. Note 3. Capital grant of 7 million naira monthly is expected in February, May, and November. Note 4. Salaries and wages for 2007 were 40 million naira. 25% of the total amount was for housing allowance. Salaries and wages will be 1.5 of the amount paid in 2007. Note 5. Ground rent for industrial estates will be received as follows: January 1.4 million naira, February 0.75 million naira, and March 1.02 million naira. Note 6. The training and development expenses of 350,000 naira are to be increased by 10% in the year 2008. The total amount will be spent on equal basis in February and October 2008. Note 7. The corporation will commence construction of 50 units of house in year 2008. The following are the commitments through LPOs in 2007, which will be met in the new year. We have items, date of purchase, LPO number, when payable, and we have the amount. Cement, it was bought on 15th of August 2007. LPO number is 4150, and it will be payable within 6 months, and the amount is 4.5 million naira. Iron rod, 15/9/2007, LPO number 4743, was purchased on 3rd of March 2008, amount is 1.4 million naira. Then gravels and sand were bought on 31st of October 2007, LPO number 5102. Date of payment is 30th of January 2008, and the amount is 0.75 million naira. Plumbing materials, 1st of November 2007, LPO number 5175. Date of payment 15/2/2008, amount is 375,500. Electrical materials, 5th of December 2007, LPO number 5223. Date of payment 31st of March 2008, amount is 625,650. Note 8. Rent receivable from the shopping complex of the corporation are January 850,000, February 750,000 naira, and March 1,250,000 naira. Note 9. The cash balance as at 31st of December 2007 was 750,000 naira. Required. Prepare a cash budget for the first quarter of the year 2008, stratified into monthly distributions. You have to prepare cash budget for the first quarter of the year 2008. The name of the ministry is Rimi State Housing Corporation of Rimi State, and you have to prepare cash budget for the first quarter of the year 2008. Now, let's have Housing Corporation of Rimi State. Rimi State. Cash budget for the quarter ended March 31st, 2008. Let's have this column for total. This is for the month of March. This is for the month of January. This is for February. And then this is for January. We have January. We have February. We have March. Then total. So we start with receipts. What are the items of receipts? Now, note 1. We're told the total annual subventions from the federal government in 2007 was 15 million naira. There is expectation that this figure will increase by 10% in year 2008. Now, working 1. Subventions. From federal government. Subvention from federal government, that is working 1. The amount given for 2007. 2007, you were told that the amount was 15 million naira. 15 million naira in 2007. There is expectation that this figure will increase by 10% in year 2008. If it increase will be 10% of 15 million. And that will be 1.5 million naira. The increase will be 1.5 million naira. The expected 10% increase will be received in the first 6 months of the year, along with the normal monthly allocation. So, monthly allocation now. Monthly allocation is 15 million divided by, we have 12 months in a year. Monthly allocation, 15 million divided by 12. So monthly allocation will be 1,250,000 naira. That is monthly allocation. And you were told that the expected 10% increase will be received in the first 6 months of the year, along with the normal monthly allocations. And the monthly allocations have been calculated, but the 10% increase which will be received is the first 6 months. How much will be received per month? Increase now. Since the increase will be received in 6 months, and the increase is 1.5 million. So we have 1.5 million divided by 6 months. That gives us 1.5 divided by 6 months. That is 250,000. If you add the 250,000 to 1,250,000, you have 1.5 million. So on a monthly basis, 1.5 million will be received. Now we have subventions. Subventions from federal government. That is working one, which is 1.5 million will be received in January, 1.5 million will be received in February, and 1.5 million will be received in March. If you sum it up, the total will be 4.5 million naira. That is the subventions from the federal government. Now, note 2. The management has decided to reduce transport and traveling by 5% in the year 2008. Transport and traveling is an expense, not a receipt. Now, let's go to the next note, note 3. Capital grant of 7 million monthly is expected in February, May, and November. Capital grant is a receipt, and you are expecting 7 million every month. That is, in the month of February, 7 million will be received. In May, 7 million will be received. In November, 7 million will also be received. So, capital grant. Capital grant. 7 million in the month of February. 7 million in the month of May. May is outside our budget period. So, the only one that falls within the budget period is the one of February. So, May is outside the period. 7 million naira. Then, note 4. Salaries and wages for 2007 were 40 million naira. 25% of the total amount was for housing allowance. Salaries and wages is an expense, it's a payment. Note 5. Ground rent for industrial estates will be received as follows. This is grant rent received. 1.4 million naira will be received in January, February 0.75 million, and March 1.02 million. So now, grant rent. Rent received. In the month of January, 1.4 million. In February, 0.75 million, which is 750,000. In March, 1.02 million. 1.02, 1,020,000. 1.4 million plus 750,000 plus 1,020,000. That is total 3,170,000. Back to the note. Note 6. The training and development expenses of 350,000 are to be increased by 10%. This is also a payment. Note 7. The corporation will commence construction of 50 units of house in the year 2008. The following are the commitments through LPOs, local purchase order, in 2007, which will be met in the new year. These are also payments. Note 8. Rent receivable from the shopping complex of the corporation are January 850,000, February 750,000, and March 1,250,000. Rent from shopping complex. Now, rent received from shopping complex. In the month of January, 850,000 was received. In February, 750,000 was received. In March, 1,250,000 naira was received. Now, total 850,000 plus 750,000 plus 1,250,000. It is totaled 2,850,000. That is the then note 9. The cash balance as at 31st December 2007 was 750,000. This is the cash balance. Now let's sum up the receipts. Total receipts. Let's label it A. 1.5 million plus 1.4 million, that is 2.9 million. Plus 850,000. We have 3,750,000. In February, 1.5 million plus 7 million, that is 8.5 million. Plus 750,000 plus 750,000. So we have 10 million naira. In March, 1.5 million plus 1,020,000 plus 1,250,000. We have 3,770,000. Then the total column, 4.5 million plus 7 million plus 3,170,000 plus 2,850,000. So we have 17,520,000. After receipts, we have payments. Let's go back to the note. Note 2. The management has decided to reduce transport. This is reduce. Has decided to reduce transport and traveling by 5% in the year 2008. The total amount in 2007 was 1,890,000, and the expenses will accrue evenly throughout the year. Now let's have working 2. Working 2. Transport and traveling expenses. In 2007 brought forward. Amount in 2007 is given to be 1,890,000. That is from note 2. So it's to be reduced by 5%. Reduction. 5% of 1,890,000. So let's calculate that. 1,890,000. 5% of that. So that is 94,500. Is to be reduced by 94,500. If you subtract that from 1,890,000, so we have 1,795,500. And you were told that and the expense will accrue evenly throughout the year. If it accrue evenly throughout the year, so monthly monthly payments or monthly allocation. Since it will accrue evenly, that means same amount will be paid monthly. 1,795,500 divided by 12. So divided by 12, we have 149,625. That is monthly allocation. Now, transport and traveling. Transport and traveling expenses, that is working 2. Monthly payment is 149,625. 149,625. 149,625 times. Now let's sum up this. So the total is 448,875. So that is note 2. Note 3. Capital grant of 7 million monthly is expected in February and May. That is receipt. That has been considered. Note 4. Salaries and wages for 2007 were 14 million naira. 25% of the total amount was for housing allowance, and wages will be 1.5 of the amount paid in 2007. Now, working 3. Working 3, which is for salaries and wages. We were told 2007 brought forward, and that was 14 million naira. So 2008 now, salaries and wages is 1.5. 1.5. 1.5 is equals to, let's convert it to a fraction, or 1 divided by 2, that is 0.5. 0.5 plus 1, it will be 1.5. 1.5 is the same as 1.5, or you convert it to an improper fraction. 2 times 1, 2 plus 1, 3. 3 over 2. 3 over 2 is the same as 1.5. So we have 1.5 times 14 million. So that will give you the salaries and wages for 2008. 1.5 times 14 million. That gives us 21 million. That means the total salaries and wages for 2008 is 21 million. We were told 25% of the total amount was for housing allowance. So meaning that if you calculate 25%, that will be for housing allowance, and the remaining 75% will be the salaries and wages. So now, housing allowance, housing allowance. Since the question is silent about it, it means it accrues evenly. 25% of salaries and wages, which is 21 million. So that will give you the housing allowance. If it accrues evenly, you divide it by 12. There are 12 months in a year. So 25% of 21 million. So housing allowance is 5,250,000. If you divide it by 12, then you have 437,500. That is housing allowance. 437,500. Now, housing allowance. Housing allowance. That is working 3. 437,500. 437,500. Total is 1,312,500. Then the remaining 75%, which is salaries and wages, If 25% is for housing allowance, the remaining 75% will be the salaries and wages. 75% of 21 million. Now, monthly allocation now will be divided by 12. That gives us 75% of 21 million divided by 12. So we have 1,312,500. 1,312,500. That is salaries and wages. So salaries and wages. Working three. 1,312,500. February 1,312,500. March 1,312,500. For the 3 months, sum it up. The total is 3,937,500. Now, note 5. Grant rent received. So, grant rent for industrial estate will be received. This is a receipt, item of receipt. So, that has been considered. Note 6. The training and development expenses of 350,000 are to be increased by 10% in the year 2008. The total amount will be spent on equal basis in February and October. Working 4. Training and development expenses. Training and development expenses. That is working 4. You were told the development expenses of 3,000 are to be increased by 10% in year 2008. So 2007 now brought forward, and that amounted to 350,000. If it's to be increased by 10%, increase 10% of 350,000. That would be 35,000. If you add it to it, you have 385,000. That means 2008 amount will be 385,000. And you were told the total amount will be spent on equal basis in February and October 2008. That means it will be the total amount will be spent in 2 months. So that means you are going to divide it by 2. Monthly allocation now, since it will be allocated to 2 months only, not throughout the year. If it is throughout the year, you are going to divide it by 12. But since it is going to be accrued in 2 months only, we divide it by 2. 2 months. 385,000 divided by 2. So we have 192,500. The amount for the month of February will be 192,500, while for October 2008 we also have 192,500. So now, training and development expenses. That is working for. So February 192,500. So October is outside the budget period. Now, note 7. The corporation will commence construction of 50 units of house in year 2008. The following are the commitments through local purchase order in 2007, which will be met in the new year. Items, date of purchase. We have purchase of cement. It was bought on the 15th of August 2007. The local purchase LPO number, local purchase order number, that is 4150. And it will be paid within the next 6 months. Since the date of purchase was August 2007, let's count 6 months from this date. After August, we have September, October, November, December, January, February. That means the date of payment of the cement purchased will be February 2008. And the amount involved is 4.5 million. So we have purchase of cement. Purchase of cement, which will be paid for in February, 4.5 million. Back to the question. Purchase of iron rod, and the amount will be paid on the 3rd of March 2008, and that amounted to 1.4 million. Purchase of iron rod. Purchase of iron rod, 1.4 million, which will be paid in March. The next item, purchase of gravel and sand, which was bought on the 31st of October 2007, and that will be paid on the 30th of January 2008. Purchase of gravel and sand, 0.75 million. Purchase of gravel and sand, and you were told it will be paid for in January 2008, 750,000, which is 0.75 million. That is 750,000. 750,000. Then we also have purchase of plumbing materials, and that is 375,500, which will be paid for in February 2008. Purchase of plumbing materials. So you were told the amount is 375,500, and that will be paid in February 2008. 375,500. Total 375,500. Then we also have purchase of electrical materials, and that will be paid for in the month of March 2008. The amount is 625,650. 625,650. Purchase of electrical materials, 625,650, which will be paid for in March. 625,650. 625,650. Note 8. Rent receivable from the shopping complex. This has been considered. Note 9. Cash. The cash balance as at 31st December 2007 was this. This is the cash balance. We have to prepare the cash budget. Let's sum up the payment. 149,625 plus 437,500 plus 1,312,500 plus 750,000. So total payments. Total payments. Let's have that as B. For January, we have 750,000. So net cash flows. The net cash flows will be A minus B. Remember, our total receipts is A, while total payments is B. Now, what is total receipts in the month of January? 3,750,000. So if you subtract total payments of 750,000, you'll be left with 3 million. In the month of February, total payments 149,625 plus 437,500 plus 1,312,500 plus 192,500 plus 4.5 million plus 375,500. The total payments in February is 6,967,625. If you subtract it from total receipts in February, the total receipts in February is 10 million. So if you subtract the payments, then you'll be left with the net cash flows of 3,032,375. Then in the month of March, the payment is total 149,625 plus 437,500 plus 1,312,500 plus 1.4 million plus 625,650. The payment in March is totaled 3,925,275. Now, if you subtract it from the total receipts in March, the receipts is 3,770,000 minus 3,770,000. Then the net cash flows. The payment exceeds receipts in March, so the net cash flows will be negative because the payment is total 3,925,275, while receipts is total 3,770,000. So the payment exceeds receipts. Payment is greater than receipts. So the net cash flow will be negative 155,275 negative. Then total column. The total column 448,875 plus 1,312,500 plus 3,937,500 plus 192,500 plus 4.5 million naira plus 1.4 million plus 750,000 plus 375,500 plus 625,650. The payment is totaled 13,542,542 525. So the net cash flows, the total receipts is 17,520,000. If you subtract your payment, 17,520,000, then the net cash flows will be 3,977,475. Then you now add your opening cash balance. Opening cash balance. If you add that, then you get the closing cash balance. Let's retotal the payment for the month of January. 149,625 plus 437,500 plus 1,312,500 plus 750,000. So The payment in the month of January is 2,649,625. If you subtract it from the total of the receipts in January, the receipt is total 3,750,000. So we have the net cash flows to be 1,100,375. In note 9, we were told that the cash balance as at 31st December 2007 was 750,000. This is the closing balance in December 2007. The closing balance in December 2007 will be the opening balance in January 2008. So we have the opening balance to be 750,000. So if you add the 750,000 to this, you have 1,850,375. 1,850,375. The closing balance in January will be the opening balance in February. 1,850,375. If you now add it to the net cash flows in February, so we have 3,032,375 plus 1,850,375. So we have 4,882,750. That is the closing balance in February. So it will now become the opening balance in March. 4,882,750. Remember, this is positive, while this is negative. So you net it. So we'll be having 4,727,475. By netting it, it means subtract this negative from the positive of this. That's what I mean by netting it. This is the closing balance in March. So that is what we are going to have in the total column. 4,727,475. So if you add it to the net cash flows, 3,977,475 plus 4,727,475. So we have 8,704,950. This is the end of the solution to this question. Please, your comment is very essential. Don't forget to like the video also. Thanks for watching ZICA.